Mark Carney has tried to dampen expectations of an imminent rise in UK interest rates. In his quarterly inflation report this morning, the Bank of England governor stressed the economy had only just started to head back towards normal. Well, Chris Giles, our economics editor, joins me. Chris, there's talk of rapid recovery, but also of slack in the economy. What's happening?
Well, one's a rate of change, so the economy is clearly recovering pretty rapidly. Growth is going at an annual rate of just over 3% at the moment, but yet it's coming from a very weak level. And so this is the slack that's there. I think we have a chart
Yeah,
which
let's
shows
show that chart. Yeah.
the Bank of England's view of this. Don't worry about what's on the axis. In fact, don't worry about what the lines actually show or trying to measure. That's not really important. What's important is the shape. So it was pretty flat around zero for most of the period between 94 and 2008. And then there's been this really big dip through the recession, saying there's lots of slack created in the economy, which is one of the reasons they want to get rid of the slack, because that way they're not going to be under pressure, deflationary pressure. And as you can see, it's closing the gap, but it's not closed yet.
And I mean, a key factor for Carney has been the rate at which unemployment's been falling, and it seems to have fallen faster, but still not enough reason for a rate rise.
Well, the bank keep changing the goalposts here. Not that they ever said they would raise rates when unemployment fell below 7%, but that was quite a significant threshold. Now, even though it's fallen to 6.8% today, and is really quite close to where they think is a normal level for this part of the cycle, they're now saying, but there's other reasons why that isn't going to have the inflationary consequences that they would normally think, mostly because people seem to want to work more hours than they're actually working at the moment. So they say, well, if the economy grew quickly, then they could actually go and do that extra work, and so you wouldn't find suddenly there was a shortage of labour.
Now, you've been arguing in a column in the FT that Carney, in your view, is perhaps a little too dovish. What's your feeling about the man and his dovishness?
Well, I think he is pretty dovish. I mean, if you were at the inflation report press conference today, and if, like us, you had an hour or so to read the report, which is a pretty neutral report, actually in some ways a little bit boring because none of the forecasts changed very much, and then the words and the tone of the governor was much more downbeat and much more sort of letting you give the impression that the Bank of England isn't going to raise rates at any time soon. And if, as we saw in the chart, actually there's not a lot of slack left, you can imagine that the Monetary Policy Committee at some point will begin to think, not that they want to get rates very high at all, but they don't want to have them at emergency levels anymore. So no one's talking about trying to slam the brakes on the economy, just maybe take your foot off the accelerator a bit. And so I think it's perfectly reasonable for people in the city to say maybe we aren't sufficiently prepared for rates to rise just a little bit, maybe earlier than we've been expecting.
Oh, well, more games to play, more discussions on that committee. Well, thanks, Chris. And for all the latest analysis from Chris and others, do have a look on ft.com and at the Money Supply blog.